So good day to you, Ma'am Jessica. Good day, everyone. So my name is Anna Rose Umambak, and my topic is all about financial statement. So before we will proceed to the discussion proper, let me read first the learning objectives. So at the end of the lessons, the students must be able to identify and explain the components of the major financial statements, the income statement, balance sheet, and cash flow statement. Create basic financial statements using a balance sheet manually or via spreadsheet software. And demonstrate appreciation for the importance of financial statements in ethical business decision making. So now, what is financial statements? So, a financial statement represents a formal record of the financial activities of an entity. So, these are written reports that quantify the financial strength, performance, and liquidity of a company. Financial statement reflects the financial effects of business transactions and events on the entity. So it is a structured report that presents the financial performance, position, and cash flows of an organization over a specific period. So it provides essential information about a company's revenues, expenses, assets, liabilities, and equity. Once you become familiar with its basic components, understanding the concept becomes much clearer and more manageable. So now, in this topic, we will talk about the three types of financial statements, namely the income statements, the balance sheet, and cash flow statement. Now we will tackle first the income statement. So income statement is also known as profit and loss statement. The income statement is the summary of a company's total revenue and its operating expenses for a given time period, such as per month, per quarter, or of a year, or for 1 year. So income statement shows a company's financial performance over a specific period, usually a month, a quarter, or a year. So specifically, it details the revenues earned, the expenses incurred, and ultimately the net profit or loss. So in simple terms, it tells us how much the company earned, how much it spent, and whether it gained or lost money during that time. So here are the various individual components of an income statement as explained briefly. So for the first one is the sales. So sales, this number represents the total amount of the revenue produced by the business. So the figure recorded here is the total sales less any product returns or sales discounts. So next component is the cost of goods sold. So it is also known as cost of sales. This number includes all of the costs and expenses directly related to the production of goods and or services, and this amount includes the cost of the materials and labor directly used to create the good. The formula for computing the cost of goods sold is cost of goods sold equals beginning inventory plus P minus ending inventory. So where P is purchased during the period. So the cost of goods sold is vital for analysts, investors, and managers in order to estimate the company's bottom line or the net profit. So if the cost of goods sold increases, net income will decrease. As a rule of thumb, if an entrepreneur wants to know if an expense has been an expense, even if no sales were produced. So the next component is the gross profit. So gross profit is this number is the profit of the company after subtracting the expenses related to manufacturing and selling its products, or the cost associated with providing its services. Here, the cost of goods sold is deducted from the sales or the revenue. So the next component is the operating expenses. So operating expenses, this include the expenses incurred every day in the operation of a business. Often expenses are divided into two categories, which are selling and marketing, and general or administrative expenses. So selling and marketing expenses are directly related to the selling of a product or service, while general administrative expenses are not directly related to the selling of a product or service but necessary in operating the business. Here are some accounts under operating expenses. So, first is the selling and marketing expenses. So, under the selling and marketing expenses are sales and sales salaries. So, these are the salaries plus the bonuses and commissions paid to all sales representatives. Next is the collateral and promotions. So collateral fees are expenses in producing or purchasing printed sales materials used by the sales personnel in marketing and selling a product and or service. Next is advertising. So these are expenses in producing and engaging in print or multimedia advertising. Last is the other sales cost. This take in all other costs related with selling a product and or service. They may not include they may include travel rather, customer meals, sales meetings, equipment, rental for presentations, copying or miscellaneous printing costs. Next are the general or administrative expenses. So under the general administrative expenses is the office salaries rather. So this include the salaries of the full and part-time office personnel. Next is rent. So this is the expense acquired to rent or lease office or industrial space. Third is the utilities. So these are the expenses: heating, air conditioning, electricity, internet, water supply, and phone usage incurred in connection with the business. Fourth is depreciation. So depreciation takes into account the loss in value of equipment, usually for a year in a business. So some examples of equipment that may be subject to depreciation include computers, office, furniture, automobiles, and buildings that an entrepreneur owns. So the last is other overhead costs. So these expenses are not clearly connected with a particular product or function. So these types of expenses may consist of insurance, office supplies, or cleaning services. So the next component is the total expenses. So total expenses, this is a sum of all expenses acquired in business without yet the taxes or interest expense on interest income if there is any. So the sixth component is the net income before taxes. So this figure is the amount of income earned by a business before paying income taxes by deducting total operating expenses from the gross profit. So for the seventh component is the taxes. So taxes, this is the amount of income taxes that an entrepreneur is indebted to the government, both local and national. So the last component of income statement is the net income. So this is the amount of money the business has produced after paying income taxes. Now let's go and proceed to the next type of financial statement, which is the balance sheet. So what is balance sheet? So balance sheet, it summarizes what the company owns, the assets, what it owes, the liabilities, and the owner's equity, the difference between assets and liabilities. So in simple terms, it answers what do we have, what do we owe, and what is left for the owners. So it follows the basic equation, which is the assets equals liabilities plus equity. So first, under the component of balance sheet is the asset. So assets is anything a company owns or controls that helps it earn money. So assets are divided into two types, which is the current assets and non-current assets. So current assets are things the company expects to use or turn into cash within 1 year, like cash, inventory, or receivables. And we also have non-current assets, which are the things that company will use for more than a year, like buildings, equipment, or land. So assets are also categorized in balance sheet on the following basis. So first is the tangible and intangible assets. So these include property, plant, and equipment, while intangible assets are those without physical substance like goodwill. Next is inventories balance. So this includes goods that are held for sale in the ordinary course of the business, such as raw materials, finished goods, and works in progress. Letter C, trade receivables. So these include the amounts that are payables from the customers upon credit sales. These are presented in the balance sheet after subtracting the allowance for bad debts. And the last component under the assets is the cash and cash equivalents. So this include cash in hand together with any short-term investments that are easily convertible into cash. So the next is the liabilities. So a liability is an obligation that a business owes to someone, and its payment could be in cash or other resources. So liabilities are classified in the balance sheet as current or non-current based on the timeline the company can resolve the liability. So a liability is something a business owes to others, like debts or obligations, and it can be paid with cash or other resources. So first is the current liabilities. These are the debts the company expects to pay within 1 year, like bills or short-term loans. And non-current liabilities, which are the debts that will be paid after more than a year, like long-term loans. So liabilities are also classified as follows. We have the trade and other payables. So these mainly include the liabilities payable to suppliers and contractors for credit purchases. Sundry payables, which are too small to be presented alone on the face of the balance sheet, are also classified in this category. And the next is the short-term borrowings. So these usually include bank overdrafts and short-term bank loans with a repayment timetable of under 12 months. We also have the long-term borrowings. These include loans which are to be settled up for more than 1 year. So current portion of long-term borrowings contain the installments of long-term borrowings that are payable in 1 year of the reporting date. And we also have the last, the current tax payable. So this is usually presented as separate line item in the balance sheet because of the importance of this amount. So the last under the balance sheet is the equity. So equity is primarily what the business owes to its owners. So this represents the remainder amount of capital in business after its assets are utilized. To settle its understanding liabilities. Hence, it signifies the difference between the total assets and total liabilities that belongs to the owners. So, equity is usually presented in the balance sheet under the following types. We have the share and capital. It represents the amount invested by the owners in the company. And we also have the retained earnings. So it comprises the total net profit or loss retained in the business once the dividends are distributed to the owners. So the purpose of balance sheet for a new business is that it indicates the capital need of the business. It also helps to identify the allocation of resources, and it calculates the requirement of seed money you put out. And also, it estimates how much finance is required. So now let's move on to the third financial statement, which is the cash flow statement. So what is a cash flow statement? So a cash flow statement is a financial report that describes the sources of a company's cash and how that cash was expended over a specified time period. It advantages for determining the short-term sustainability of a company, specifically its ability to provide payment for bills. It is highly recommended that an entrepreneur studies his cash flow statement at least every quarter because of its importance to the success of the business. So, a cash flow statement shows how much cash goes in and out of a business during a certain period. It helps owners see if the company has enough cash to pay bills and keep running smoothly. So sometimes a business looks profitable on paper but still lacks enough cash. That's why checking the cash flow is important, especially every quarter. So the cash is divided into three types of activities. The operating, which is the money from daily business activities, and we also have investing, which are the money spent on or earned from assets. And we also have financing, which are the money from loans or owner investments. So, a cash flow statement is distributed into sections by the same three functional areas within the business. So, we have first the cash flow from operating activities. So, this refers to cash produced from the daily business operations. And second, we have the cash flow from investing activities. So this refers to cash used for investing in assets as well as the proceeds from the sale of other businesses, equipment, or other long-term assets. And we also have the third, which is the cash flow from financing activities. So this cash is paid or received from issuing and borrowing of funds. So fourth is the net increase or decrease in cash, which refers to the increases in cash from previous year will be written typically, and decreases in cash are usually written in brackets. So in conclusion, financial statement is really crucial to make your business thriving and successful because you can monitor your cash, and also you can monitor if it will going to be successful or not. So that would be my discussion all about. I hope that you learned something from it, and that I hope it is fruitful and insightful. Thank you, and God bless everyone.